Anyway, welcome to MIT and welcome to the MFin program. I hope all of you come. And one of the things that I'm going to do is to try to convince you to come by describing a little bit about why you might be interested in finance at all. Now, I suspect that most of you are already interested in finance, otherwise you wouldn't have bothered applying, but you might not know why you're interested in finance. And I'm here to tell you that there's some really important reasons why you should be interested in finance, why, in fact, everybody should be interested in finance. Now, I have to admit I'm biased, and you know, perhaps like other faculty here at Sloan, I too believe that my field of finance is the most important field in the world, and certainly at Sloan. But I think the difference is that in my case I'm right, and so I'm going to try to convince you of that, not so much by lobbying you, but rather by doing a little bit of finance, and just trying to illustrate how it could be that finance is the reason that we will ultimately be able to solve some of society's biggest challenges. So this is a rather ambitious title, How Financial Engineering Can Cure Cancer, Stop Global Warming, and Solve the Energy Crisis. But I actually mean that quite sincerely. And so in the next half hour, 45 minutes, I'm going to try to illustrate to you how it's possible for finance to do it, and actually how it's possible for one of you in this audience, or a few of you here today, to actually be the source of these solutions. Now, that's a tall order. I recognize that. Particularly, it's a tall order because finance has received a very, very bad name through the financial crisis. And so I would be remiss if I didn't spend just a few minutes talking about the financial crisis. But actually, I want to change your perspective a little bit and argue that because of the financial crisis, I think that we actually have an enormously powerful proof of concept of what finance is capable of both good and bad. So I'm going to take a few minutes to take you through the financial crisis. I'm going to do it in just one slide. I've managed to compress the entire crisis to one slide, thanks to the miracle of PowerPoint and animation. And after we talk about the financial crisis, I'm not going to try to explain it. I'm not going to try to talk about the origins of it, because that's quite complex. But at least I want to get down the narrative of what happened, because I think that once we see what happened, you'll understand the kind of opportunities that I'm talking about. So here's the financial crisis in one slide. As many of you know, in the 1990s, we had a period of low interest rates, and a number of financial institutions, including banks, but not limited to banks, so commercial banks, investment banks, mortgage companies, government-sponsored enterprises such as Fannie Mae and Freddie Mac, and politicians, all worked together to create a variety of financial products designed to provide potential homeowners with the resources to be able to purchase homes, mortgages, in other words. And with the help of financial innovators and financial innovations, such as securitization and credit default swaps and CDOs, and with the help of rating agencies and insurance companies, during the 1990s and the early 2000s, we were able to pump an enormous amount of money, trillions of dollars, from investors such as pension funds, mutual funds, sovereign wealth funds, foundations, endowments, and hedge funds into the U.S. residential real estate market, really through an unprecedented sales force that basically provided all sorts of financial innovations that allowed individuals who otherwise might not be able to afford homes to be able to purchase homes. And so we had a housing boom. From the 1990s to the early 2000s, housing prices continued to go up, but actually it continued a trend that began decades before. For a period of 40 or 50 years, housing prices did nothing but go up. And during the late 1990s and early 2000s, that sped up dramatically because of these financial innovations and because everybody along the way, all the individuals involved in this food chain of residential real estate, were incentivized to issue lots and lots of mortgages. And so many homes were built and purchased. And the idea was that after all of these homeowners got into their homes, they would pay back their loans and provide very attractive cash flows for various different investors. And those cash flows were made even more attractive by the miracle of securitization, of credit default swaps and protection, tranching, and ultimately of being distributed in a broad fashion across all of these investors. That was the idea. But of course, as we know, in the middle of 2006, housing prices peaked. Starting in 2004, interest rates began climbing up. The Fed began tightening monetary policy. And as interest rates rose, and as the housing market peaked and then started coming down, homeowners had a harder and harder time making their mortgage payments. And after the teaser rate periods of these adjustable rate mortgages went through, they began defaulting. Defaulting in... Sorry about that. I read a book recently on how to make PowerPoint more effective, and so you guys are my guinea pigs. Also, I have to keep students awake because some of the material is a little dry. So they began to default, and as they defaulted, the cash flows stopped. And then, little by little, these financial institutions got hit. One after another, they failed. And it started hitting all of these financial institutions, and about the only institution that did well were hedge funds. So that's it. That's the financial crisis on one slide. And you might ask, well, what was the effect of all of this? How did all of this happen? And you know, the housing market, what was it affected? Well, here's a summary of how it affected housing markets. This is a graph of U.S. residential real estate prices from 1890 to 2006. And these are real prices, meaning they take into account inflation. So I'm not comparing apples with oranges, right? These are all using constant dollars in purchasing power. And it graphs the value of U.S. residential real estate from 1890 all the way to the peak of the housing market in 2006. Does anybody notice anything unusual about this graph? Yeah, the last 10 years were spectacular for the housing market. An unprecedented rise in residential real estate to what we now know as unsustainable levels. And by the way, today, the housing market, if I continue the graph, we'd be somewhere back down here. We're back at this sort of steady state average of between 100 and 120 for the index. And that average persisted for about 50 years before the 1990s. So what happened during the 1990s? Well, what happened was financial innovation, securitization, credit default swaps, financial engineering of all sorts. And of course, many people participated in that. And I don't know how many of you watch CNN on a regular basis, but shortly after Lehman Brothers went under in 2008, CNN started a little segment that they called the Hall of Shame. And this Hall of Shame actually featured individuals. They would show the pictures of individuals that they deemed to be directly responsible for the financial crisis. People like Dick Fuld, the CEO of Lehman Brothers. Christopher Cox, the head of the SEC, was featured in the Hall of Shame. And you know, at some point they stopped. And I think it's because they ran out of room, because pretty soon everybody ended up being in the Hall of Shame. Because if you did an honest accounting of who was responsible for the financial crisis, you would end up coming up with homeowners, commercial banks, investment banks, and issuers of all of these securities, mortgage lenders, brokers, servicers, trustees, credit rating agencies, insurance companies, investors, regulators, government-sponsored enterprises, and politicians. Everybody played a role. Now, it's not to say that there wasn't bad behavior that needs to be rooted out. There is, and it will be. And it's not to say that all of these are equally at fault. Obviously, the process of fault finding is still ongoing. But the fact is that the reason that the housing market doubled in value from 110 to 220, that chart that I showed you, the reason that we had such an unprecedented rise was the combination of financial engineering and securitization and the fact that everybody along the food chain was incentivized to issue mortgages and get people into homes. In fact, that's not necessarily a bad thing. For example, I was one of the individuals that was partly responsible for the financial crisis. Why? Because in the 1980s, when I first moved here to MIT, I bought a house in Lexington. A house that I financed with 5% down, not 20. 20 standard, 5% is low. And I couldn't qualify for a 30-year fixed-rate mortgage, so I got a 3-year adjustable with a 1-year reset and a teaser rate that allowed me to qualify. And if it weren't for all of these financial innovations, I wouldn't have been able to get that loan. So there are many examples of people that benefited, but obviously we also know that there's some great fallout and a lot of pain that's been inflicted on others. So it's a complicated set of issues. But the reason that we had this huge run-up, I think that's clear. The reason that we had so much money pouring into the housing market, for good or for ill, is because everybody along the way was incentivized to do so. Now, I want to keep this in the back of your minds, because in a few minutes, I'm going to turn it around and say that that possibility will ultimately be the solution to some of society's greatest challenges. So let me continue and ask the question, is financial engineering to blame? And I want to turn now from the financial industry to other industries. And I want to argue that in other industries that are technologically sophisticated, we have crises as well. The Space Shuttle Challenger, Space Shuttle Columbia, Chernobyl, the Minneapolis bridge collapse, train wreck in Scotland, 3 Mile Island. These are all examples of disasters. Disasters that really, in my view, are the consequences of technology gone awry. That is, the fact that we've developed very powerful, very sophisticated technologies is a wonderful thing, but many technologies have unintended consequences that we have to deal with. Now, let me make an even broader claim. And the broader claim has to do with this graph over here. Does anybody recognize what this graph is? Does this look familiar?
Federal Reserve balance sheet or something?
That's a good guess.
Population of the world.
Yes. So Federal Reserve balance sheet is a good guess because we know that that's gone very, very high. It's grown exponentially. But it wouldn't look this regular, and it wouldn't go back to minus 10,000 BC. You're right. This is the population of the planet, the population of Homo sapiens from 10,000 BC to 2008. And the reason that this is so striking, I don't know if we have any closet biologists in here, but if we did, you can confirm the fact that there are very few species on this planet that have a growth curve that looks like this. In fact, the only one that I know of, having grown up in New York City, is the population of cockroaches during the summer in New York. And when that happens, you call the exterminator, and boom, it comes back down. There are very few species that have grown literally unchecked and continue to grow. I mean, just to put numbers on this, in 1900, that red dot says that the planet had about 1.7 billion people on it. That was 100 years ago. We had 1.7 billion. As of 2008, we have, actually, this is even an outdated figure, it's more like 7.5 billion. 7.5 billion people. That's an incredible rate of reproduction over a span of 100 years, which is an eye blink in evolutionary timescales. How did this happen? How are we able to reproduce so effectively? Well, the answer is technology. We have been able to squeeze more out of the same amount of natural resources that we had at our disposal 100 years ago. It's technology. All sorts of technology. We're more efficient about manufacturing. We're more efficient about food production. We're more efficient about transportation. All of these technologies play a role in allowing us to reproduce at whatever rate we want. And we have to recognize, though, that technology is a two-edged sword. It has some wonderful properties allowing us to grow in this way. But as we grow and as we run into these various different constraints, we will reach limits that have to be dealt with new technologies. But technologies have unintended consequences. And financial technology is no different. Global warming is an example of an unintended consequence. The impact of pesticides on our health, birth defects, that's an example of an unintended consequence of technology. And I would argue that the financial crisis can be viewed as an example of a technology gone awry. We were far better at raising money and placing money than we were at managing the risks of that money for a variety of reasons. I'm not going to talk about that, but I do want to make the point that really we want to focus on technology and its role in dealing with these kinds of issues. Now, it turns out that finance plays a critical role in technology. I'm going to argue that finance is really what makes technology possible. And that might be a bit of a leap, because, you know, money versus technology, what do they have to do with each other? In fact, when you think about the way that technology is financed, it turns out that money has everything to do with it. And I want to give you some examples of that. So here's a chart of the productivity of the United States in terms of gross domestic product. The blue bars is US GDP from 1947 to 2009. We've been very productive in the US. Our GDP has grown exponentially too. However, it hasn't grown in a random fashion. There are certain sectors that have done well and other sectors that have not. And so let's take a look. The two sectors that I'd like you to consider are the goods-producing sector, the parts of the economy that produce stuff, like widgets, or whatever. And the other part of the economy is services-producing sectors. And the US National Income Accounts differentiates those two and computes the value added of the two sectors as a fraction of gross domestic product. And that's what these two curves are, the purple and the blue. The blue is the proportion of our gross domestic product attributable to goods-producing sectors. And what you see is, as a percentage of GDP, it's been declining virtually monotonically since the 1940s. A smaller and smaller proportion of our US economy is devoted to producing widgets. And a greater and greater proportion is devoted to producing services. And part of those services is financial services. So to be very specific, let's take a look at the difference between, say, manufacturing and finance and insurance. The green line is the value added as a percentage of GDP of the manufacturing sector. And you can see that, again, not surprisingly, the United States has been losing ground in terms of producing stuff, in terms of manufacturing. Why? Because a lot of the jobs are going overseas to countries and labor forces that are much less expensive at producing stuff than we are. On the other hand, the purple line down here, that's going up slightly, but definitely year by year, is finance and insurance. We're actually more and more becoming a finance and insurance-oriented economy. And there's a reason for that. I'll come back to that in just a few minutes. Let me talk about employment. Let's talk about the number of people that are employed. And you'll find this interesting. So these bars represent, again, services producing and goods producing. The blue is goods producing employees. And you see something really interesting. The number of people employed in the goods producing sectors of the economy has been about the same throughout the last 5 or 6 decades. Since 1947, there have been approximately 20 million people in this country focusing on producing widgets. And the dark purple bars are the number of people devoted to services. We're becoming more and more of a service economy in terms of sheer number of people employed. But what I find even more interesting is if you look at manufacturing, the number of people in manufacturing has actually declined from where it was in the 1940s. It went up for a while, so we had quite a few more people employed in manufacturing as the economy grew. But now we employ even fewer people, and yet the actual dollar magnitude of gross domestic product attributable to manufacturing is far greater. What does that tell you? That tells you that each person today in the United States is a lot more productive in producing widgets than ever before. The value added per person is a lot higher thanks to technology, thanks to automation, thanks to greater skills and training. But what about finance? If you look at finance, the number of people employed in finance, that's the green line, that's been going up steadily. And now, if I ask, what is the per capita value added in the two sectors, you see a little bit more about what we're talking about. In finance and insurance, the per capita value added is actually growing at a much faster rate than the manufacturing sector. We've made lots of improvements in automation and manufacturing, but there have been even more improvements in what individuals can do to help finance and ensure those kinds of technological developments. And let me turn to the bottom line. What do we pay these folks? Salaries. Well, it used to be the case, and the folks at MIT get really annoyed when I show this graph. You'll see why in a minute. It used to be the case that if you got an undergraduate degree in engineering, you would be able to make a lot more money than if you got an undergraduate degree in finance or accounting. So in the 1970s and the 60s, the difference in pay between finance and engineering was close to 100%. In other words, you can double your salary by switching majors from finance to engineering back in the 1960s and 70s. That's not true anymore. Now, it turns out that as an undergraduate, if you got a degree in finance, you're looking at something like a 20 to 30% premium above an undergraduate degree in engineering. This is why folks at MIT are really annoyed by this. We're an engineering school, but the fact is that because of the movement of our economy to producing services as opposed to producing widgets, finance and insurance have become a lot more central to creating value than producing goods. Not to say that producing goods is a bad thing, certainly not. But nevertheless, finance has been growing that much more quickly. And now if you look at graduate degrees, which is what all of you are considering, the graduate degree difference between engineering and finance, it's almost flipped on its head. Now you can almost double your salary by switching from engineering to finance. And there's a reason for that. The reason is not that finance is more important than engineering or that it's more, it's more intellectually challenging. The fact is that it's in more need right now. There's a higher demand for finance than there is for engineering. It's basic supply and demand. And so this is a good thing for all of you who are about to get a finance degree, but there's more to the story than just this. I know that most of you are not interested in doing this just to make more money. You want to have a career that's satisfying, that's intellectually challenging, where you can actually change the world. And I don't mean that as a platitude. Within the next 15 minutes, I'm going to actually show you how you can literally change the world for the better. So let me turn to the question about why is it the case that finance people get paid more than engineers? Why is it the case that we have this change in the dynamic? And the answer, I think, is actually pretty simple. It's because innovation of any sort, but particularly technological innovation, requires financial infrastructure. Any kind of major development in any discipline, I don't care whether it's medicine or chemical engineering or manufacturing or automobile production, any serious innovation requires proper financial structure. And what does that mean? It means private investment. Government funding is not enough. It may be useful to get things started, but ultimately you need to have private investment in order to get innovation off the ground. Second, you need well-functioning capital markets. You need to be able to buy and sell units of ownership in these kinds of innovations. Third, you need to have the proper design of securities, because in order for people to collaborate, they need to know what their risks are and what their rewards are. And for that, you have to have properly designed securities, debt, equity, and everything in between. Fourth, you need to have the proper accounting, legal, and regulatory structures set up to be able to do that. And finally, you need to have a certain degree of systemic stability. All of these are necessary in order for you to be able to get innovation off the ground. And it's really because the bottom line is you need to have incentives. You need to have people wanting to do what it is you hope them to do. You can't force them to do it. You can lead a horse to water, but you can't force it to innovate. And sorry for the mixed metaphor. And there are a couple of ways to do it. One way, of course, is to scare the heck out of people. And that's what we do very often. In fact, the media is constantly doing that. The reason that you watch the news is not because you want to feel good, but because you're scared that there's something on the news that you need to know that you don't know. I'm sure you've seen these segments, like in the afternoon. Can milk stunt your children's growth? More at 11. And what am I going to do? How am I going to watch this to figure out what I'm doing to my children? And fear works very well in getting people moving right away. But the problem with fear is that it's not sustainable. You can't be scared for years and years. Or maybe you can, but physiologically that's extraordinarily punishing. There's a lot of wear and tear with the fear circuitry of the human physiology. And we can declare a war on terror, we can declare a war on drugs, we can declare a war on cancer, but wars really can't be waged for decades. Greed works a lot better. Putting a price on cancer's head is a whole different matter. Making sure that people get paid for solving cancer, that's a different matter. And so what I want to argue is that the reason finance is important is because it's the key to coming up with the incentives to do what it is that we'd like people to do. And I want to give you an example of that. And then I'll turn to cancer as well as the other challenges. I want to give you an example that actually has nothing to do with cancer or the financial crisis. It has to do with something called the DARPA Challenge. Anybody heard of the DARPA Challenge? Okay, so very few. Well, there's a reason for that. It's a rather obscure and frankly quite nerdy type of a challenge that even nerdier than the Jeopardy challenge that Watson apparently won recently. It has to do with a contest that was sponsored by the Department of Defense, in particular by the Defense Advanced Research Projects Administration. This is part of the Defense Department that gives out money to university faculty to do really cool research that sometimes becomes a missile or some other kind of defense project. And they wanted to celebrate a very big anniversary of theirs. So what they thought they would do is to put out a contest. And the contest was this. They were going to position 10 weather balloons randomly in the United States. And the challenge was, how long will it take for you to find out the locations of all 10 weather balloons? And the team that could do that fastest would win $40,000. Okay? You have to give the exact location of these 10 weather balloons, longitude and latitude in particular. And they announced this in advance, and they said, as of a particular date, we will have these balloons in place. And starting on that date and at that time, when the balloons are announced, you have to go find them. And that's the only information that they gave out. How would you do it? Could you do it? How long do you think it would take? Any guesses as to how long you think something like this would take? No other rules. No other information. It could be anywhere in this country. It has to be out in the open, though, so you have to be able to see it. It can't be tucked away in the basement of a building locked behind a door. That would defeat the purpose. How long do you think it would take? Any guesses?
A few hours.
2 hours?
A few.
A few hours. A few hours. That's pretty ambitious. A few hours. I mean, 10 randomly located balloons in the entire United States. And we're talking about, individuals like you. How would you go about doing it? Think about how long it would take. A few hours? Yeah.
I would say maybe a day or two, but I would imagine you'd use crowdsourcing of some sort.
Okay, crowdsourcing. How? How would you do that? Let's go through it. So let's say you use Facebook, right? And you put a few balloons on Facebook, and you say, please help me identify the balloons. I don't know how many friends you have on Facebook and how many of those friends are interested in spending time looking for balloons, but it sounds to me like even if you get, 100 people looking for balloons, the United States is pretty big, right? I mean, this wasn't limited to urban locations. It wasn't limited to, cities and shopping malls. This could be, in the middle of the Cheyenne Mountains. Or, Nebraska is a pretty big state. It could be in the middle of, Lincoln. Texas, I just came from Texas yesterday. Texas is a humongous state. Someone told me that the entire population of the United States could actually fit into the state of Texas with everybody having a 2-acre lot. But then you have to live in Texas. That's Some parts are beautiful. I love Austin. I love San Antonio. But, do you really want to live in Dallas? I don't know. Anyway, so how would you do it? How long do you think it would take? I mean, even with crowdsourcing techniques, what is the technique? How would you go about it? If you posted it on Facebook or Craigslist or whatever, it's hard to get people's attention, isn't it? I mean, it's hard enough for me to get my faculty's attention when I send out an email as the faculty head. I can't get them to respond to my emails about various things. How do you get them to respond about finding a balloon? Yeah?
Incentivize them.
How? That's right.
Give
How?
them part of the prize if you win.
Exactly. So the team that won happened to be an MIT team. It was won by Sandy Pentland at the Media Lab along with his students. And there they are with the $40,000 check. And how long did it take them? It took them under 9 hours. Under 9 hours. And the question is how? And you're absolutely right. It was through incentives. The way they did it was financial engineering. And the kind of financial engineering was really beautiful. What they did was this. They said on their website, they said, whoever helps us to identify the location of one of these balloons will have a fraction of the winnings of the $40,000. And they told them what the fraction was. But that's not all. If you don't find the balloon, but you tell somebody about this challenge, and they find the balloon, and you can prove that you're the one that told them to look for the balloon, then they will get a piece of it, and you will get a smaller fraction. If you told somebody that found the balloon, then the person who found the balloon will get the biggest portion, the next person will get a smaller portion, and you will still get a fraction, but an even smaller portion. So in other words, no matter where you are in that chain of discovery, you will get paid. Everybody gets paid along the way. Everybody. Until the entire $40,000 is spent. So they spent the entire $40,000 on all of the people that got involved. There are about 10,000 people that they got involved in this. Now think about it. Does this sound familiar to you? The idea of everybody getting paid a little bit along the way? Yeah, that's the financial crisis, isn't it? This is the financial crisis in a nutshell, except here now the purpose is not to pump money in real estate. The purpose is to find 10 balloons. We did it in under 9 hours. To me, that's astonishing that it could happen so quickly. And it is crowdsourcing. But it's not just crowdsourcing. It's great to say, yeah, let's use Craigslist. How? Let's use Facebook. How? It's financial engineering. In the end, it's financial engineering. It's about the financing. You get the financing right, the rest of this stuff is child's play. And so the point of this example is that when financial infrastructure exists to provide the proper incentives, large-scale innovation is not only possible, it's absolutely realistic. And secondly, when financial infrastructure is not in place, then I would argue large-scale innovation is impossible. Financial infrastructure, the proper financial engineering, is both a necessary and sufficient condition for innovation. And obviously, the financial crisis was a terribly gut-wrenching, frustrating, and damaging event for many, many people. But if there is a silver lining to it, it is that this demonstrates the possibility of tremendous, tremendous resources that we can bring to bear on all sorts of challenges. In fact, I would argue that the financial crisis is the equivalent of Albert Einstein's E = mc squared. The fact that a salt shaker has implicit in it enough energy to run the United States for a year in terms of the energy need is a remarkable thing. And I would argue that the financial system, global capital markets, has enough resources to solve all of these problems many times over. And I'm going to try to illustrate that to you in the context of society's biggest challenges. I'm going to argue that this extraordinary run-up of real estate prices is a proof of concept of what we can do. We can pump trillions of dollars of assets into a variety of different things as long as we get the financial engineering right, as long as everybody makes a little bit along the way, as long as we don't get greedy and try to keep it all to ourselves. If we're willing to spread it out in a mathematically sophisticated way, anything is possible. And so in particular, I want to argue that we can take financial engineering and apply it to lots of things, not just making money for ourselves, which, by the way, we need to do. You're not going to do anything substantial if you don't allow people to benefit from it in some manner. And I'll give you an illustration of that. I want to argue that finance can facilitate collaboration by providing proper incentives, and that with financial engineering, I'm going to make a very bold claim. And my claim is that these three challenges, cancer, the energy crisis, and global warming, can be solved within 2 decades. Within 2 decades, if we have the right financial structure, if we have enough talented individuals using their knowledge to tackle these problems, I claim that within 20 years, all 3 of these will be solved. Now, you might ask, how? And usually at this point, I've run out of time, so I can't tell you. Unfortunately, I do have a little extra time, so I have to tell you something. And the short answer is, I don't know. But I have an idea. And the idea actually involves all of you. So let me tell you my idea, and you tell me whether you think this is realistic. And let's start with cancer. Now, I don't know much about cancer, but I do know people that have suffered from it. I suspect that everybody in this room either has experienced it or has dealt with it through friends and family. It is an extraordinarily significant challenge to society. And it's complex. How complex? Well, first of all, drug discovery, as you know, is a very complicated process. And in particular, the typical cancer drug takes approximately $500 million of money just for the drug development process from beginning to end. And that's just the out-of-pocket costs. That doesn't include the time value of money. It doesn't include opportunity costs. It's literally the dollars that have to be spent in order to take an idea to the end of the drug approval phase from beginning to end. And it's very risky. Only 5% of these drug development programs actually end in a commercially viable drug. 5% success rate. And it takes about 10 years from beginning to end. From the beginning of the research to the end of the FDA approval process, you're looking at 10 years, sometimes longer. So just out of curiosity, if that were the investment opportunity, how many people would be willing to put some money in that? How many people would be willing to give me money? I need 500 million of it so that in 10 years, I got a 5% chance of success. Anybody? You be willing to do that? No? Maybe? You're thinking about it? It depends on the rate of return. The rate of return depends upon what you can get for having a drug like this. And then you've got to get whatever that is, you have to multiply by 5% probability of success, take the expected value, deduct the risk premium. And the answer is probably the rate of return is about 0 or maybe minus 5%. Sound good? No. Okay. Well, there are many different ways of fighting cancer. There is angiogenesis, blocking the blood supply to cancer, or there is stem cells, or there is radiation therapy. Lots of these different therapies. And big pharma companies can't possibly pursue all of them. So here's a thought. What if we could raise $20 billion in a single fund or corporation whose sole purpose is to cure cancer over the course of the next decade? That's all it was going to do, is to focus on cancer cures, therapeutics for cancer. A $20 billion fund devoted to that. Doesn't exist today. In fact, $20 billion is today's research budget for the entire National Institutes of Health, a one-year research budget for everything. It's $20 billion. I'm talking about raising $20 billion and targeting that just for cancer. Would that be interesting? Well, let's do a little math. If I had $20 billion, what could I do that I couldn't do with $500 million? Well, for one thing, I could fund 40 projects. Now, why is that interesting? Well, if I took 40 potential cancer drugs and each has a 5% success rate, what do you think the success rate would be for the entire fund over the course of that 10-year period? And let's make the assumption that these cancer drug potentials are uncorrelated. In other words, whether one succeeds or fails has nothing to do with whether another succeeds or fails. They're statistically independent. Anybody tell me what the probability of success might be in that case for my $20 billion cancer fund? How would you figure it out? I see wheels spinning. How would you figure it out? Well, what I'm asking is, what's the probability of at least one success in 40 trials that are independent, with a probability of success for each one of 5%?
1 minus 0.95 to the 40.
Exactly. It's 1 minus the probability that they'll all fail. And the probability of failure is high. It's 95%. But I got 40 tries. With 40 tries of failing, it's going to be hard to all fail, because 0.95 to the 40th power is not a very large number. In fact, the answer is I have an 87% chance of success. With an 87% chance of success, now the rate of return that you asked about is not 0 or minus 3% or 1%. You know what it is? When you do the back of the envelope, and this is very much back of the envelope, maybe back of a manila envelope, it's a bigger envelope. When you do that, you get a compound rate of return about 10% over a 10-year period for this fund. Now, does this look attractive to you? I don't know what your portfolios look like, but a 10% rate of return over 10 years and a rate of return that's statistically uncorrelated with the S&P 500, because whether or not the S&P goes up or down has very little to do with whether or not you solve cancer. That's an extraordinary opportunity. It's pretty attractive. Now, can we do this? Well, I don't know. It depends. It depends on the financial structure. It depends upon the cancer drug development process. It depends on the science, the mechanisms of cancer. It depends on a lot of things. But I know that there's a possibility here with the proper financial structure. If everybody along the way gets paid for curing cancer, I think there's a chance we can cure cancer. Now think about the scale of this. I said 20 billion. Maybe that's not the right scale. Maybe it should be 10 billion. Maybe it should be 50 billion. Whatever it is, if the financial crisis has taught us anything, it's that these numbers are trivial. We spent $130 billion on AIG. We spent $40 billion on General Motors. The interest on TARP was greater than this. This is nothing. We can do this. Now, how do we do this? Well, suppose that we ask each household. There are 10 million households in the United States today. Suppose we ask each one of them to put $2,000 of their 401k money into this fund. Do you think they might be willing to do that? Would you be willing to put $2,000 of your 401k money that you're not going to need for another 30 or 40 years anyway, because you're not going to be retiring until then? Would you be willing to put $2,000 of your dollars into a fund like this? There's $20 billion right there. We can do this. This is feasible. And of course, there are lots of other issues that have to be resolved. There's a lot of financial engineering to be done. We need smart people to do it. That's where you guys come in. Any one of you can do this with the proper training, background, and motivation. It's not about making yourself rich. By the way, if you do this, you will be rich. I guarantee you. The person who puts this together will be wealthy beyond all imagination. But in my view, that's justified. If you can cure cancer, you should be rich. God help you, because you're going to be helping a lot of people. That's the power of financial markets. It's a win-win for everybody. Now, since I've run out of time, I can't talk about the other two, but trust me, I have reason to believe that we can solve the energy crisis and we can deal with global warming with all sorts of technologies that are possibly feasible with enough resources. So the key is, can we get those resources? I think we can. I think we can use financial engineering not just to make ourselves wealthy, but to make ourselves much better off. You can do well by doing good. And really, that's what we want to focus on. There are so many students that we graduate at MIT from engineering programs, so many of them, very few in finance. That's why we started the MFin program. It's because we want to get the very best and the brightest focusing on these issues, because we just don't have enough talent. rather than shying away from financial engineering, our view is that because of the financial crisis, we actually need more financial engineers. We need more people sophisticated about finance. And that's where all of you come in. With the financial structure that is designed to take into account incentives, properly structured, anything is possible. Anything is possible with the right people. And we think all of you are the right people. So the hope is that you'll all come to MIT and help us change the world. Thank you. Time for a few questions?
Yes.
Okay, great. Questions? Comments? All ready to sign up? Terrific. Yeah. No checkbooks. No, we don't want your money. We don't want your body. We want your soul. We want all of you. We want you to be committed to this. So, yes.
Can you comment on what are the forces that push American economy to a service-oriented economy, and are those forces going to continue for the future?
So actually, that question I can answer almost immediately, at least in a broad sense. The forces that have been pushing us towards a service economy is a rather simple observation. It's that population growth across the globe has created labor forces that are far more effective and far cheaper in other countries than in the United States. That's plain and simple. So, you know, last month I bought a new TV for the first time in many years, and you know, I was astonished by a few things. I bought a Samsung flat panel LCD LED display. It was like 40 inches. It was a monster TV. I was quite embarrassed to buy such a thing. And I thought it was going to be really heavy. I asked one of my friends to come help me pick it up and all that. I ended up being able to carry it myself. It's a 40-inch TV, and it's this thin. And it's astonishing, the technology. I paid, I don't know, $500 or $600 for it, whereas a few years ago it would have been several $1,000s. That's wonderful, right? It's wonderful because now the cheapest labor force is being used to produce that set of components. It's being produced in Korea, India, China. It's not being produced in the United States. So we've lost a lot of jobs, even though the United States was among the pioneers of the television industry and the television itself. You don't hear about Zenith or Magnavox anymore. They're gone or taken over, and they're owned by other companies. So the fact that we have population growth has really changed the dynamic of the world. And think about just China and India for a moment. As we know, there's been a lot of change in their political landscape over the last 2 decades. And what has happened is that we now today have a labor force of approximately 750,000, if not a billion people that 15 years ago weren't gainfully employed. So imagine what the impact of an economy is if one day a billion people showed up for work and they said, okay, we're now ready to work, we're very hardworking, we're smart, and by the way, you don't have to pay us. Think about that. What would happen if you had an influx of very cheap labor? Everything changes. So the traditional manufacturing methods no longer are viable because the competition is simply going to make the economics unsustainable. So that's one of the reasons why the traditional industries in the US are really moving and shifting. It's because of change in population, change in the political landscape, and the change in the underlying economic dynamics. And we need to adjust to that reality. We need to focus on what we're good at. We need to figure out how to deal with the jobs that are being lost and retrain our population in order to be able to compete effectively. Other questions? Nope. Okay, well, again, congratulations for being admitted. I hope to see you all in the fall. Thank you.